Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod. Is America's healthcare healthy? Former FDA head Scott Gottlieb weighs in on innovation, operations.
I think the larger story here has been just the degradation at the agency in terms of departures.
And the impact of major philosophical and structural changes to the largest healthcare regulator has on our future.
So you're seeing a hollowing out of the scientific staff at the FDA, and that's starting to impact early reviews.
And the industrial revolution we're living in an age of emerging artificial intelligence, technology investor Mitchell Green.
We just believe this is like the internet bubble all over again, where this stuff is going to completely revolutionize the world over the next 20 years. It's just we are probably still in the 1999.
Plus, the July jobs report hits Wall Street and Washington, the big tech companies' big earnings, the Figma IPO that soared, and a flurry of late-night tariff deals from the White House on trade deal deadline day.
It's a wild situation.
I'm hearing he still wants Canada to join the union. He wants Canada.
It's Friday, August 1st, 2025. Where does the time go? Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernen and Andrew Ross Sorkin. And it's Friday.
Yeah.
And we're here.
Yeah.
And it's a jobs Friday on top of that. Down day yesterday, at least for the S&P 500 and the Dow. The Dow is down now for 4 sessions in a row. So is the Russell 2000.
The NASDAQ closed down yesterday,
Did
too.
it close down? At the end of the session, it was
down 7 points.
Okay, so it gave
But
back
it was up.
everything.
It was like up
it
350.
hundreds of points
Yeah,
because
it was.
of what happened with both Meta and Microsoft.
Gave it all back.
Now people are a little worried about what's happening for this. 4 months in a row, though, the NASDAQ has closed higher. The Dow closed higher for the month, but just barely. I think it was up by 0.08% for the month. S&P did okay. It was up for the month as well. You did see a small gain for the Dow in July, and that's what I just said. The NASDAQ was the big winner, though. It was up by 3.7%. The Russell 2000 had the small cap Russell 2000. What did I see? I said that wrong before. What had 4 months in a row of downs?
The third straight month of gains. I'd normally.
I see different streaks from here. Okay, it's third straight month in a row of gains. That's its longest monthly winning streak in about 4 years. Treasury yields this morning, if you check things out, you're going to see that the 30-year yield is now at 4.9%, a little higher than we had seen yesterday when it fell back in the 4.8% range. The 10-year's at 4.39, and then the 2-year's flat. It's just below 4% at 3.95. Also, check out copper prices. Yesterday was its worst day ever. That came on pared back tariffs from the White House. There were tariffs that went through, but it wasn't on everything that they had anticipated. This morning, you're seeing a very slight bounce back of just 1%. For the week to date, we're still down by close to 24%.
President Trump ratcheting up tariffs on countries around the world with a new rate set to kick in within days. I should say new rates because there's a lot of them, and we want to get the very, very latest this morning from Megan Cassella. Good morning to you.
Good morning, Andrew. So with one executive order overnight, the president, as you said, increasing tariffs and adjusting them on dozens of countries across the world. All of these new rates set to take effect within 6 days from now, August 7th. So take a look here to break down everything the president has been doing. 7 trading partners now. This includes the EU, South Korea, Japan, locked in those framework deals, locking in those tariff rates of between 10 and 20% on all of their exports. And then another 62 countries, by my count, also saw their tariff rates, so-called reciprocal tariffs, increasing. Those will be between 10 and 41%. Those are on some major trading partners. That includes India at 25%, Thailand and Malaysia both at 19%. So some significant levels there. And then for nearly everybody else, the baseline tariff will remain at 10%. So a little bit of a surprise there that that level didn't move higher. Now, all of that, again, taking effect next week, but 3 countries not included in any of those categories were China, Mexico, and Canada. So China holding firm at 30% where it's been for now. Mexico also holding the status quo at 25% after it struck a deal yesterday to keep negotiating with the White House for another 90 days. But Canada never reached any sort of deal. So overnight, its tariff jumped 10 percentage points up to 35%. So now you can take a look at it this way. I think this simplifies everything that happened. About 65% of everything the U.S. buys from abroad comes from just 5 trading partners. and tariffs on all of those goods will now start at a minimum 15%. And guys, President Trump spoke with NBC after he signed this executive order yesterday. They were talking about the tariffs. He said it is too late as of now for other countries to avoid these tariffs. But at the same time, he said his door is never completely closed to compelling offers. So that doesn't mean someone might come along in 4 weeks from now or something like it and could strike some sort of a deal. So on that question of how firm these are, he's leaving the door open at least a little bit. Guys.
So I think the big question is, what do you think happens next week? That's the entirety of the question that the whole market and the whole world wants to know.
They do. So I will say White House officials said in putting this August 7th deadline on there, yes, you could look at that as giving some leeway and maybe an optimistic sign that things won't take effect. The president to NBC says, of course, he's not striking any deals, but we have heard that before. White House officials say that this is simply to allow customs some time to adjust what they're doing at the border so that they know what level of import taxes to collect. And importers then also have a few days to adjust to what they're going to have to be paying. So I wouldn't say it means that he's going to strike deals between now and then, but of course, that is a byproduct of it. This allows some wiggle room, and he does say, and officials have been saying, they're going to keep negotiating.
Right. Well, on the keep negotiating piece, is there anybody else meaningfully that you think is close, meaning that a deal is within reach in these couple of days, that this actually is a negotiating tactic that forces the issue?
Yeah. Canada is the biggest one left out there. As of late yesterday, it was 4 o'clock or so, the president said Canada had been calling. He hadn't talked with them. So I'm really curious what happens with Canada, just given the size of the trading relationship. There have been others, Malaysia, Thailand, not insignificant trading partners that the White House yesterday was telling me were very close. So we could potentially see those adjusted somewhat. So I would say potentially some partners in Asia. The biggest question, though, the one that will matter the most, is Canada. And given the president's rhetoric, I just don't know if he'll strike anything between now and August 7th.
Okay, Megan, thank you. Appreciate it. It's a
Still,
wild situation.
It is. I'm hearing he still wants Canada to join the union. He wants Canada to, you think, it makes everything a lot easier, saves everybody a lot of money. Still
to join.
They don't
yes,
want
this union.
to.
I know, but he still
upends his own politics.
Huh?
It would upend your politics, the country.
Believe me, I know it'd be like adding 100 Minnesotas. That's like the last. I said I'd trade a couple of those.
No, I know you've said that. That's why I'm surprised.
I'm not saying it. I'm just saying I know for a fact that he still thinks that makes sense. Take a look at Apple. After fiscal third quarter results, sales and profit beat estimates. iPhone revenue easily topping expectations. Overall growth of 10% was the company's best performance in a quarter in more than 3 years. Apple CEO Tim Cook said about one of those 10 percentage points of revenue, the growth came from customers buying iPhones to get ahead of tariffs that were imposed in April. On the tariff front, Apple said its third quarter hit was less than expected and had projected back in May. Cook saying that the fourth quarter impact, though, could be about $1.1 billion. And in a reversal from the past 2 quarters, Apple saw sales in China rise 4%. For fiscal fourth quarter, Apple said it expects a mid to high single-digit increases in overall revenue.
That's what I thought was interesting.
Yeah.
If they think that this was selling to get ahead of those tariffs, but they don't see it slowing down in the current quarter. That's kind of interesting to kind of weigh that out, how they measure that, how you figure how much was pulled forward, how much wasn't.
Given how much the stock has come down and how positive a lot was yesterday, you would have maybe thought more than a 1.8% gain.
Yeah.
People are still, there's some trepidation still about Apple. On AI, Cook noted that the company is significantly increasing investment in CapEx in both talent and computing, though he didn't give specific numbers.
And then there are shares of Amazon, which are falling on second quarter results. Profit and revenue both beat expectations, with sales growing by 13% year over year. But the company gave some light operating income guidance for the current quarter. On the cloud side, Amazon Web Services was up by 17.5%. That was better than had been anticipated, but it was nothing compared to the amazing results you'd seen from Microsoft Azure, where their cloud revenue was up by 39%, and then Google Cloud, where their revenue was up by 32%. Capital expenditures, the company CFO at Amazon saying that capital expenditures in the second quarter actually topped $31 billion. That was up incredibly, something like 90%, and will remain at that level in the second half of the year. Tariffs were another topic in focus. And here's Amazon CEO Andy Jassy on that earnings call.
Through the first half of the year, we haven't yet seen diminishing demand nor prices meaningfully appreciating. We also have such diversity of sellers in our marketplace, over 2 million sellers in total, with differing strategies of whether to pass on higher costs to consumers, that customers are advantaged shopping at Amazon because they're more likely to find lower prices on the items they care about.
For the second straight quarter, Amazon included recessionary fears and tariff and trade policies as factors that could affect its guidance. And again, that stock is off by about 7.75%. Year to date, it's down by 1.5%.
Take a look at shares of software design developer Figma soaring. And when I say soaring, that's probably an understatement in their public debut yesterday. The company pricing its IPO $33 a share. That was originally open for trading yesterday at $85, then closed at more than $115. At that point, Figma's market cap was close to $70 billion. You remember, and we've talked about it, Adobe agreed to buy that company back in 2022 for $20 billion. But that deal had fallen apart over concerns from British competition regulators. And we spoke to Figma CEO Dylan Field pre-market yesterday before all of the craziness began. And here's what he had to say about possible M&A activity of what they may do next.
Expect us to take big swings. Maybe that's on AI, maybe that's with M&A at scale. And I thought it was really important for people to know that. I still do. Because obviously M&A, if it's done well, is often misunderstood. It can create volatility, and we don't have a plan for that right now. We're always looking.
Right. Shares of Figma right now, pre-market, $129. Two pieces. He did have a comment where he talks about the idea of you don't want to look at the stock price for one day because it could be a drunk elephant. That was his comment in the morning. I don't know if he looked. I don't know if you think this is a drunk. I don't know if this is a drunk elephant or not. We'll see.
Share price is moment in time. We're going to see all sorts of behavior probably today, over the weeks ahead. I'm not going to say it's just noise. You can't tell people that don't look at the elephant in the room. There's an elephant in the room. It's dancing. It's drunk. But I think at the end of the day, what's really important here is that we control the inputs. And so what I've been talking about with the team is we have to stay focused, stay on mission, listen to our customers.
The other thing is we mentioned his compensation package yesterday, which is very Elon Musk-like with these market cap targets. Well, guess what? He already blew through some of them.
Well, he only had to get to $60, right?
For the first tranche.
Days.
It has to be there for 60 days, but then there's other parts where they have to be for years. So, and then he has to hold. So, we'll see. But it is quite something. The other question, of course, and Bill Gurley talking about this on X last night. How much money did Figma just leave on the table? How mispriced was this?
Bankers leave
if you're Dylan on a morning like today, or at the end of last night, beyond going out and hopefully having a cocktail, are you saying to yourself, I'm having a cocktail because I'm excited and I'm celebrating, or am I having a cocktail because these Wall Street bankers screwed this up so badly in terms of the supply and demand of my shares and how they were priced? And that's still always the question.
Because the company didn't get the money it could have had.
I mean, it's just,
Were they selling shareholders, or was it just for general corporate purposes? Were they selling shareholders?
No, so most of this cash that was going to be raised was actually to pay taxes, weirdly enough. It was not like a huge big cash.
In the past, we've always, and we've been, a lot of times been wrong, to say that when you see a certain number of shares trade at a level like that based on demand for people that can't get in, it's a mistake to multiply the total number of outstanding shares by that price and think that suddenly
it was 40 times over.
Right. But you can't monetize suddenly that if everybody wanted to sell and take their, what's the market cap now? If everyone wanted to do that, that money probably doesn't exist. But every time we said that about Google when it opened at like 80, and it's up probably 100 times.
Right.
So I'm not saying it's not going to happen, but I don't understand. I haven't heard the term drunken elephant before. Is that like a drunken Republican or what?
Drunk giant.
I don't know if I would right now take it to the bank. And it also sort of, your bigger question about M&A and IPOs and sentiment and everything else.
Well, I'll tell you,
that's frothy, isn't it?
The number of people yesterday who I was on the phone with who said, bankers who were just watching this in awe with their mouth agape, and saying there was a whole bunch of companies that wanted to come public who are now saying we need to do this immediately. Like the window is open, let's go.
And by the way, you can't blame the bankers too much.
No,
I mean, maybe.
I think it's a great.
What if it fell apart?
I think I'd rather have you do it that way and set a basal level for where that thing opened, and suddenly everybody's thinking about it not as a $20 billion company anymore. Right. So when you conjure up all that demand, and it's like the guy at the Velvet Rope at some stupid club down in Soho. You know, and you get in there, no one's in there. There's a big, huge line.
As if you ever made a pass.
That's happened 30 years ago, and nothing ever happened. I had no success. I don't know why I was waiting in line. I should have never waited in line. But it is, wow, that was something. I thought there was
something to behold. I have to say, I was watching.
I remember. And I still have no idea what WTF that. I mean, I was listening to him. And I wanted to understand really bad, and I stopped listening because I don't see how they can possibly design a rollout of some idea that a person has. I don't know why they need thousands of employees. I don't know what they're doing. I don't know what kind of idea they're talking about. I don't know how it could be, that skill could be worth $50 billion or whatever it is. Can you explain it to me?
I think it's 58.
How does it, what do they do and why could it be, and how can someone 25 years old have figured this out?
He's 33.
Okay.
It's effectively a design.
Okay. I was listening.
It's a piece of design software.
Tried to understand.
You and I, let's say we wanted to build an app. And
why don't we?
Beautiful. We could.
Then let's.
With this software, we could go do it. Today, you could do it with a prompt. So 4 months ago, professional designers used this software, and they would move things around. And if they were making an ad or a design on by the way, Netflix uses it in terms of the way the Netflix screen looks, all of that, they would be doing that. Today, you don't even need to do that. Joe, you and I could and Becky, we could just type in what we think the screen should look like.
Design me a screen.
Basically.
Is that ability? So that seems, again, what's the underlying product or service that we're selling in is just the ability to do that worth all this money?
Well, what they have is it's an enterprise business where effectively the top Fortune 500 companies, everybody uses this software.
They do.
They do.
For advertising.
Well, not just for advertising, for anything that's design related.
To design something. Okay. All right. I'm trying.
I'm thinking about the jobs that are on the line. Who gets laid off as a result of this stuff because it's so good now.
Will you work on that so we can, Becky, you want in? He just said us.
I'll stay here. You guys go away. I'll hold down the fort here. You guys go do your thing.
Bird in the hand.
Yeah.
Cheese will be next.
Coming up next on Squawk Pod, the president pushing the chairman of the Federal Reserve on Jobs Day and the impact of major changes to the nation's healthcare regulators. Former FDA head Scott Gottlieb on what's happening at an agency he once ran.
If you look at the drug center, they lost about a third of their reviewers that review breast and gynecological cancer products. They lost more than half of the group that reviews malignant heme products. They've seen 473 departures of medical reviewers, voluntary departures, on top of about 600 RIFs. That's more than 20% of that center.
This is Squawk Pod from CNBC with Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Here's Andrew.
Guys, got to tell you about this. President Trump just posting on Truth Social some more criticism right now for Fed Chair Powell. He's saying now the following, quote, Jerome Too Late Powell, a stubborn moron, he's now calling him, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everybody knows has to be done.
I guess he's talking about the FOMC board, which, by the way, there were only 2 dissents in the vote that just came through.
Yeah, first time there were 2 since 1993.
Yeah.
You know what? He could get even louder if it's a crappy jobs number.
Yep, we'll see.
All right, President Trump ordering pharma companies to lower drug prices in the United States over the next 60 days. Joining us right now to talk about this and changes at the FDA, plus much more, is former FDA Commissioner Scott Gottlieb. He's also a CNBC contributor and a board member of both Illumina and Pfizer. And Scott, let's talk through what this might mean. This is a strict letter. President Trump tried to do this in the first Trump administration with an executive order that the courts struck down. How likely is this to get some pickup from the industry? Do you think they'll go along with it?
Look, I think this is a good starting point for the industry to have discussions with the administration. The president clearly is focused on this issue. He has been through 2 terms right now. This sense that there is unfairness between the United States and our Western allies, mostly in Europe, who are paying much less for pharmaceuticals in the U.S. I think it's a fundamental issue of fairness for him. He tried to do this through a regulation in the first term, through a demonstration project at the Centers for Medicare and Medicaid Services. That was struck down. In the second term, he's begun to try to do that again. I think this may be an indication that they're having difficulty coming up with a regulatory framework that's going to pass judicial review. And so they're looking to do it through negotiation and a little bit of jawboning. I think this is a good starting point. They recognized in the letter that the president put out that this should apply prospectively, meaning that companies can't go back and renegotiate the prices that they've already established in a lot of these countries. So he's saying that he wants companies to do this on a prospective basis, basically for new drug launches within the commercial and the Medicare market. The one piece of this I think is going to be very difficult for the companies is that he wants the companies to offer the MFN price, the most favored nation price, day one within the Medicaid program. That's not necessarily going to benefit patients. It will benefit states by lowering their drug spending. But that's going to be very difficult in terms of the revenue hit to companies. In many cases, the difference between the MFN price, depending on how you calculate that, and the letter doesn't specify that, and the prices paid in Medicaid could be substantial for some single-source drugs. Ultimately, and my final point here would be, I think we need to move towards some type of tiered pricing globally, where you basically price drugs based on the wealth of nations, and you have different prices for low, middle, and high-income nations. Because a country like Germany, with a GDP per capita of 54,000 per person, can pay a lot more than Vietnam with a GDP per capita of 4,000. So I think we do need to price public health goods to what countries can pay and their wealth ultimately. But this is a good starting point.
That sounds like something that the United States Trade Representative would have to enforce. Are you suggesting that what we get out of this is not lower prices in the United States, but higher prices in other developed countries?
Well, I think it's both. And the president, in those letters that he sent, was very clear that he wants prices in the U.S. to come down if prices in Europe and other nations are going to go up. And they did commit that the trade representative and other entities within the U.S. would support companies. That's going to be critical. There was a moment in time where we tried to negotiate some of these provisions into free trade agreements. It got into the FTA with Australia and South Korea as well. I think we need to go back to that, where the U.S. trade apparatus is willing to support companies that try to push back on some of these pricing authorities globally. But the president was clear in the letter that he would expect that if the United States does support manufacturers in being able to raise their prices overseas, that would mean lower prices in the U.S. Now, ultimately, how you measure that would be difficult, but I think there are ways that you could probably look at that over the long run. But, I think in terms of where the administration's position has been and what we knew the president wanted to do, there were some things in this letter that I think were some thoughtful, frankly, concessions on the part of the administration, particularly that provision about looking at this mostly on a prospective basis for new drug launches, with the exception of within the Medicaid program. The one piece of this I think could immediately impact consumers, and the industry has been having discussions with the administration about this, is offering some kind of portal, some kind of online portal, a direct-to-consumer portal, where companies would agree to sell to consumers directly, for those who are underinsured or uninsured, drugs at MFN-type pricing for heavily rebated drugs. And in those instances, probably the ex-U.S. prices are pretty close to the U.S.-based prices once you factor in all the rebates that are paid in the U.S. And so that's something that could provide some immediate savings to certain consumers.
That might work. Scott, I'm just trying to historically figure out how we got in this mess and who's to blame. I mean, the first time someone over in Europe suggested that they were going to start controlling prices, who went along with that? Was our government asleep, or FTC or trade regulator? Did the companies just allow themselves to be taken advantage of just to continue to be able to sell abroad? Or how did we let this happen to us, so now we're in this position. It should have never happened in the first place. How did it happen?
Yeah, I think it's a little bit of all the above. U.S. authorities let other countries put in place these price control regimes and didn't support manufacturers in pushing back against those. And it's hard to do if you're a private company.
Whose administration was that?
Government.
When was that happening?
Yeah, when did most favored nation?
Yeah, I mean, that really happened over, I would say, the late 1990s and early 2000s. A lot of these regimes went in. Some of them went in earlier than that. If you look at countries like the UK, Germany started to put these really draconian provisions in place probably in the mid-2000s. But the bottom line is, if you're selling a pharmaceutical product, number one, you want to price it to what the market can pay because these are public health goods. And also, these cost very little to manufacture. That's just the bottom line. The cost of goods is very low. And so if you can still eke out a profit in Germany selling it at 50% of the price you can gain in the U.S., that's still profit to be had. So companies are going to try to sell as much as they can to as many countries as they can based on what those markets are willing to pay. I think if the USTR is willing to step in here and really support manufacturers in pushing back against some of these regimes and make this a component of how they negotiate overall trade agreements, the U.S. administration, I think we can make some real progress here. And I think this letter, frankly, was a good starting point. I was surprised yesterday by the negative reaction in the markets relative to where the president has been. This is no surprise. And I think they did make some thoughtful movements here, the one being looking at this just on a prospective basis for most drugs. That's going to allow companies to go into these markets now and say, we're launching this drug at a world price, take it or leave it. And then you're going to need the support of the U.S. government to make sure they don't compulsory license that medicine.
Scott, let's switch gears. We had Dr. Marty Makary here, the current head of the FDA, earlier this week. One of the things we brought up with him is what's happening with gene therapy, other innovative therapies and drugs that are out there, because there have been some concerns, particularly around what we saw with Sarepta. What are you hearing?
Well, look, there's been about 4 recent situations with respect to gene therapy in particular and things that went through that biologics center where you saw a recent departure of the head of that center that surprised not just, I think, the markets and consumers, but also the companies. And you saw them put out statements, and I think you referenced this in that interview, where companies, the CEOs said, we were surprised, we felt basically the rug was pulled out from us at the 11th hour. You don't typically see companies come out and make statements like that unless they really think the rules were changed on them. I think the larger story here has been just the degradation at the agency in terms of departures. That biologics center has seen 106 departures since the beginning of the year. That's on top of about 150 RIFs that were also part of that center. If you look at the drug center, they lost about a third of the reviewers that review breast and gynecological cancer products. They lost more than half of the group that reviews malignant heme products. They've seen 473 departures of medical reviewers, voluntary departures, on top of about 600 RIFs. That's more than 20% of that center. So you're seeing a hollowing out of the scientific staff at the FDA, and that's starting to impact early reviews. When you talk to the companies, and I do talk to a lot of small companies, I work at a venture capital firm, they're starting to say that the feedback that they're getting from the agency and their ability to engage with the agency, have meetings, are not as robust as they used to be. Things that used to be meetings in the past where you'd get verbal feedback now are written response only and things like that. Bio actually did a survey of its members and they quantified this. They haven't put out the results of that survey yet, but they're quantifying on a systematic basis that the quality and the pace of the interactions that early companies have with the agency has gone down, which is not surprising given the scope of the departures and the firings that we've seen at FDA. It's going to have an impact. So there's rebuilding to be done right now at the agency.
Vinay Prasad leaving, does that improve the situation? Does it change the situation? Or is it too late because these people have left and it's going to take a lot of time to rehire among those ranks?
Well, look, I think it's going to improve morale if you talk to people within that biologics center and how they felt about the leadership composition within that center. And it's going to, of course, depend on who they get in place. There's discussion that, that Kennedy, Secretary Kennedy, was supporting Vinay Prasad, and part of the concession that was made in terms of getting Kennedy to agree to his departure was that the vaccine group would be split out from the biologics center and they would appoint a new head of that vaccine group, presumably someone who shares Secretary Kennedy's views about vaccines. I think that would be very destructive to the agency and further erode morale. So things like that are allowed to happen, where you get people who are anti-vaxxers, for example, to oversee the vaccine division. It doesn't just affect vaccine review, it affects the overall morale in the agency, where people in the agency who are scientists, who are dedicated to the public health mission of that organization, feel that there's political meddling and intrusion in the decision making, and that they can't they can't exercise their scientific judgment because there's sort of preconceived notions about what the outcome should be. And that's a feeling that's permeating that agency right now when you talk to the rank and file. So I think we need to get back to basics with FDA and try to support the scientific decision making of the staff and support recruiting good people into that agency and retaining them.
Dr. Scott Gottlieb is the former head of the FDA in the first Trump administration. Scott, thank you for talking this through with us. I know this is a conversation that will continue. We're watching it closely, and I know you are too. Thank you.
Thanks a lot.
Next on Squawk Pod, fighting the AI talent wars with venture capitalist Mitchell Green.
The likes of Facebook, Microsoft, and Google and Amazon are paying engineers like they play in the NBA. OpenAI can offer equity, but these companies can offer like hard cash. The dilution at some of these private AI companies is absolutely insane.
What's going on behind the scenes in Silicon Valley? Right after this. Welcome back to Squawk Pod.
Up and Andrew, Q.
You're watching Squawk Box right here on CNBC. I'm Andrew Sorkin along with Joe Kernen and Becky Quick. And boy, do we have a lot going on this Friday morning.
Alibaba is taking on Meta's wearables with AI glasses of its own. It's the latest in the U.S.-China battle for AI dominance. Joining us now, Lead Edge Capital founding partner Mitchell Green. Mitchell is a longtime investor in Alibaba and Ant Group. He's also an investor in ByteDance.
The real question will be, how many years do I get to come on here until we have till I get to come on for like the ByteDance IPO? That'll be that's the $1 billion question.
Looking at a lot of your thoughts and comments, I think you're very excited about AI and what can happen. But would you buy any of the top tier leading AI companies at this point? And is there a way to engage in this transforming?
What's going on?
Yeah, is there another way? Where else can you do it if you don't want?
It is clearly transforming. I mean, all your viewers.
But you wouldn't buy any of them. You wouldn't buy any of the main.
We're not buying. I think the way you play it, especially if you're a retail investor, you should go buy the hyperscalers that you can see are putting up, and they're going to dedicate massive amounts of capital to this space. Whether it's Facebook. I think Amazon said they're going to spend $60 billion or something in the second half, and spent $56 billion in the first half. I think Google said they were going to spend $85 billion or something. We really don't know how you compete against those giant hyperscalers, and the cost to serve a search with with Anthropic or OpenAI versus Google, who spent the last 20 plus years.
So you think they become the winners of this?
We think they're the big
and you
winners.
think, therefore, where do you put an? So some people are saying they want to get access to like an OpenAI. And they would say the way to do that today, oddly enough, would to say either to buy into Microsoft, right? Because embedded in they have a big investment, is in OpenAI, or into SoftBank. Those are two public, effectively, vehicles.
SoftBank, you get a lot of other stuff. Look, if you're a wealthy enough individual, it's been rumored that both Anthropic and OpenAI, actually these companies are constant fundraising companies.
Yeah, of course they are.
Which also means you're going to get diluted. We have not invested in the big models. And by the way, we're idiots. We should have. We could have invested in some of these early. And again, you could sell the stock. I know people that invested early and have already gotten out and made a bunch of money. Our concern is, we could be completely wrong, is that how do we know these aren't Excite, Lycos, and AltaVista? Search engines from the 90s that had massive consumer trends. You might argue, I can take this side of the argument, that OpenAI is dominating the hearts and minds of consumers. The DAUs and MAUs are just through the roof, so they'll win. They can attract the best talent. Here's the problem. The likes of Facebook, Microsoft, and Google and Amazon are paying engineers like they play in the NBA. And so the amount of not only OpenAI can offer equity, but these companies can offer hard cash. What they did with what Facebook did with Nat Friedman, who's a dear friend of our firm, an absolute rock star engineer. But the dilution for these companies, it's something that a lot of people in Silicon Valley, people don't talk about enough. The dilution at some of these private AI companies is absolutely insane.
That's interesting.
Nobody talks about this.
Yeah, nobody really does.
While the biggest, some of the best innovation is coming out of Silicon Valley, and it's for the last 20 years, and will continue for a long time. The amount of stock option dilution that at the same time also comes out of these this area is absolutely just remarkable, would be one way to put it.
That's how they're
it's
holding.
Good to be it's good to be an engineer.
That's how they're holding on to the talent, not because they have a more open workplace and we're going to let you do what you want and all these things. No, it's that you get to own a
piece of the company. And the
piece
crazy
of the
thing is, never before have you seen really the amount of dollars that are being given to some of these AI engineers.
It's more than 100 million, right? That's the headline we've heard.
Some of these numbers
are multiples bigger than that.
By the way, they're like NBA players.
Yeah.
Right. Right. A lefty with a good. They can also hit.
Tell all your kids to become they're in college to become AI engineers.
But it's still it's not something you would assume that instead of buying the companies that are going to be selling into all that capital expenditures from the big mag. Haven't you buy the people that are actually spending the money instead of the ones that are benefiting from supplying the.
They're just giving money, not stock.
Yeah.
They're giving money. They're not. And
that's enough of a reason.
It is crazy. We're sitting here today, and after yesterday's earnings pop, Facebook is a $2 trillion company, growing. What did earnings grow yesterday? I think top line grew like 20 or something like that. So not only are they seeing. They're making investments, but they're seeing margins increase as well. The DAU count at Facebook is absolutely incredible. I think the best way to play AI is go buy the big hyperscalers yourself. And they're not crazy expensive on an earnings multiple.
Just trying to see how do they use AI to leverage, I guess that everyone uses it differently to leverage their own business, their business.
Okay, here's a question for you. Who pays down the road? Like what are the iterations? Because this stuff is really expensive. I heard recently that there's a healthcare company that doctors work for, that this healthcare company wants the doctors to pick up part of the expense for the AI agent to make them more efficient. And the doctors are mad, obviously, about what happens with this. It gets to that question of who does pay for the expense of bringing the artificial intelligence on board. It's not cheap. It's going to hurt margins if you don't have a way to offset it.
And several people could argue it's going to be commoditized.
Yeah.
Well, you might argue, how has Google become the cash printing machine it has? The advertising business, obviously. Who pays for the ads? At the end of the day, it's probably consumers. Although on the flip, you could argue prices. That means prices should go up and things like that. I think people always overestimate technological change in the near term, and they always underestimate it long term. We just believe this is like the internet bubble all over again, where this stuff is going to completely revolutionize the world over the next 20 years. It's just we are probably still in the 1999, 2000.
And then the question is, how do you pick the winners and losers now? Because it was not clear then. It
was not clear then, which means it's probably not actually clear now. I do think there is another interesting thing. So I was with a retired CEO earlier this week of a large consumer goods company, and he's on the board of a bunch of big companies. And I asked him, are you now starting to see, like the AI, they'll get board report, are you now starting to see like real ROI from some of these AI projects, like internal? And he said they are now, it's some of the boards he's on, in dribs and drabs, not widespread yet. They are starting to see like real ROI with this stuff.
Do you think the market follows suit, and if we're in 1999, that there's a 2001 coming?
Everybody sure seems bullish. And one of my dear friend Steve Cohen from Point72 and SAC always says, if you ask 10 of the smartest hedge fund managers, or go ask 50 people on the street where the market's going, and if 48 of them say one thing and 2 says the other thing,
go with the 2.
Go with the 2. And if you do that over and over again, you'll probably make money. It just seems that, as Ed Yardeni has said, the market just keeps grinding higher. Yeah. I don't know. And I think what will make it pop is something that I have no clue what it is. You guys don't. I don't know. It just seems like we're a little complacent
Jesse
right now.
Livermore said it before anyone. He still jumped, I think.
Yeah.
All right. Thank you.
As we round out this last podcast of the week, some economic data that we were all waiting for with Rick Santelli.
The big July jobs report. Non-farm payrolls up 73,000. Definitely a bit light, but maybe it's the Goldilocks.
Well, we'll see about Goldilocks. Today's report also revised data from previous months to much lower numbers than were originally reported. Our Steve Leisman explains the significance.
It's just right now we need to be very careful that we do have a job market that is substantially weaker than we thought.
It wasn't a great report.
This gives everybody, something though, Rick. It gives people that hate the tariffs are killing the economy. People that want interest rates to come down, see, I told you so. The labor market's weakening and there's no inflation. This is going to give everybody on both sides of all the issues just a bunch of stuff that they're going to point to.
This July jobs report, as well as the one to come for August, will likely factor into the Federal Reserve's next decision on interest rates to come in late September. But for now, this week, as we learned, the central bank believes in holding interest rates steady.
President Trump just posting on Truth Social, too little, too late. Jerome, too late Powell is a disaster. Drop the rate. The good news is the tariffs are bringing billions of dollars into the USA. Clearly, the president thought that his tariffs were actually going to have this impact and therefore needed the Fed to make these moves.
And that's Squawk Pod for today and for the week. Thanks for listening. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern. Squawk Pod, this very podcast, is available wherever you like to listen to podcasts. It is produced by me, Katie Kramer, and Cameron Costa. John Lesration is our editor. Have a wonderful August weekend, and we'll meet you right back here on Monday.
We are clear. Thanks, guys.